Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I'm Arjun Patsarthi, and in this podcast, we are going to talk upon a very important topic, which is why do corporate bond issuers default? Now, the question is, does how many of the issuers default in India, especially? It's actually very low, very low. Rating agencies data will tell you that it's in very minute percentages, but still they do default, and there will be defaults going forward due to various reasons. Now, investors do get caught when issuers default. We have seen high profile defaults in the past, including very large companies like IL and FSS and DHFL. This has really created a lot of issues in the market for investors, and a lot of institutional investors too lost money. But also, retail investors do get caught in these by investing in funds that have invested in those defaulted bonds, or some of them have been invested directly also in these bonds. It's very difficult for retail investors to understand which bond is good, which bond is bad, especially if they don't know the whole process of doing due diligence on corporate bonds. But having said that, given that in India at least, we have seen very low percentages of default. But if the default happens, there is definitely investors do definitely lose their capital. So the basic premise is that investors should understand that corporate bonds carry default risk. That is, they can lose their capital if the issuers cannot pay their capital back. Now, in this podcast, we are going to talk about why some issuers default. And uh, there are various reasons to that. Some of them can be external to the company, beyond their control. Some of them also very internal to the company, which is well within their control. But why do some of these companies are suddenly become unable to pay back capital? So let's get into those issues right now. One is the let's take the external factors, for example, right? And the one of the main examples of an external factor of default is that 2008 2009 financial crisis, where many of the investors who have been investing for a longer period of time did see a sudden sharp decline and risk aversion in global markets, which affected India as well. And this also created a lot of liquidity issues for corporates in India. And many of them were not strong enough or were unable to access capital to tide over that liquidity crisis, did face default issues, right? But this was more of a global problem. It did emanate from a global financial market crisis, and it spread all over the world, and it spread to India as well. And yes, some of them did have a big issue in accessing capital to maintain their business operations. So this is on the external front. And what are the main causes of external front? Clearly, one is overheated markets, over leveraged markets globally, very high, heavy risk, capital flows that were on carry trades, other geopolitical risks, inflation, deflation, currency risks. So a lot of these issues do come to the fore. And because that the capital flows freely across the world, the way where even a small issue emanating in from one place can affect the global markets. And India, in that sense, has become a very big economy in the global markets as well as the global market itself. And anything happening in India too can affect a lot of can affect a lot of markets across the globe. So clearly, we are just not the recipients of global waves of crisis, but we can also create waves of crisis. But having said that, 2008-9 was a very classical example of external issues. And here we saw there was a huge credit risk aversion globally. which took up corporate bond yields to very, very high levels. And that created a huge amount of risk aversion to providing liquidity to corporates to manage even the regular working capital and the service debt and business operations. And this did affect many corporates. So it resulted in the governments and the central banks supporting the economy and the corporate. The other crisis came when in the 2020 COVID, when suddenly the whole world shut down, and clearly this was a completely external to corporates, and they did face a huge liquidity crisis. But at that point of time, there was central banks coming through and supporting the corporate bond market and bond issuers to make sure that they had enough liquidity to carry on their business operations and to service debt. In India, there was one particular period when demonetization happened. That was a one-off event, and that also saw a lot of lenders seeing a lot of bad loans, and suddenly they had to face a crisis of liquidity, and that too affected their ability to service debt and also running their own business operations. But again, these are all one-off external factors. But having said that, there are good. There have been many in all these examples in all external events. Those corporates who have managed their balance sheet and their business operations well, especially the way they ran the finances of the company, they were able to tide over the crisis with some help, but they were not in a very dire strait. But there were those corporates that didn't manage their finances very well, and they saw the brunt of the repercussions of these events, and they went into liquidity issues, and some point where central banks could not really support them, they went into a default kind of a mode. So coming to the internal factors, right? What are the main factors that lead to corporate bond defaults, right? One is clearly that over leveraging. That is, if they have borrowed too high to expand their business, right? And suddenly there is no takers for their products or services, or if they're lenders, if they have overlent by borrowing too much, and then finding that the borrowers are not able to repay, then they find it unable to service that kind of a heavy debt they have taken on their books. Then in this case, what happens is that to get more debt, they need more equity, but equity is not forthcoming, because for example, if it's a listed corporate and the share price has fallen some 80% because of these issues, then they're not able to raise more equity. And when they're not able to raise more equity, then lenders stop lending to them because the debt equity ratio becomes too high. And then they find that they don't have enough liquidity to service interest and repayment of principals for the debt they have taken on their books. And this leads to a default kind of scenario. So the first point is that what is the kind of leverage, that is what is the kind of borrowings as the corporate taken, and is it is it enough, is it too much for them to or for the whole business to become extremely risky when a few things happen, it is either within their control or beyond their control, and this leads to one default. The second is obviously the fact that the corporates do, if they have misused the capital. So this is a governance issue, right? So if they have misused capital, that is, if they have too many group companies or the promoters are not governing the company well and taking out capital So when they have borrowed and the money is not going into, say, for example, for a lender, they're not lent to, they're not lent to the borrowers they are supposed to provide loans to, but the money is being taken out and invested somewhere elsewhere, say in real estate or anywhere else, then when things go wrong, they are unable to repay the debt, that is, and also service interest costs, and purely because that their asset is not where it should be, they find it difficult to liquidate, securitize, or whatever to raise capital. So this purely is a governance issue, and this is very important for investors to understand that governance is one of the most important factors to look at while investing in a corporate bond. Now, there are various ways to look at governance, and that depends on what your advisor or what your own due diligence says on how to look at the governance factor. One of the main one of the main factors you need to look at is obviously if the corporate has too many group level entities, and if there is a question mark on governance, then one would have to wonder if one entity borrows, and then what are the inter corporate lending that is taking place within the group and all that other factors. So this is very important factor to note. The third is also the access to liquidity, right? So now a good, very strong promoter does of a, say, a lender of an NBFC uh, can always access liquidity because their own balance sheets are strong and they have enough strength in the market to borrow and to support their subsidiary NBFC. And if they're an NBFC promoted by say a strong group of private equity investors, sovereign wealth funds who have shown support and who are taking responsibility if anything goes wrong, and that they are willing to support the lender in terms of a crisis or in terms of bad times by providing fresh equity. So then that is a good sign. So but there are also many lenders or many bond issuers where there are a group of investors, but nobody has a very large percentage of the capital. And here, what happens is that no single investor is willing to take responsibility when things go bad. And here, the bond issuer still faces a lot of issues. And if things go bad, then there becomes a liquidity crisis, and then they get into a very difficult mode to be able to pay service interest or the principal of the debt they have on the books. So all these can also have a very strong factor, which is the intent of the promoters of the company or the investors of the company to make sure that the company is well funded and they are willing to stay with the company in up through ups and downs. So that's something which is very important. A good promoter driven company obviously has much better access to liquidity, and they can go through a lot of lean periods without any facing any issues. But but an issuer that is not that has promoters who are either weak or do not have the interest or to stay with the company at bad periods, then they get into a lot of issues. So there's one factor that needs to be taken care of as well. So the quality of promoters, the quality of investors, and their commitment to the company is very important while investing in a corporate bond. The next is obviously there could be the kind of profile of lenders, right? So if corporate has taken a lot of most of the liabilities, that is the borrowings are from say banks or institutions, and then there is a sudden liquidity crisis in the banking system, then or there is an issue in banks bad loans itself or their own balance sheets, then what these banks tend to do is they stop providing more leverage or more capital in the form of debt to the company. And if they need to replace these borrowings, and the corporate bond market is not very forthcoming in giving them the capital required to either service their existing debt or to run the business itself, then this there could be some issues. So the quality of the liability profile, so good mix of bank lending, corporate bond market, and other sources, including equity capital, is a good sign that the company has got a good liability profile, and also they are able to get liquidity when required from various market segments. The other factor that investors need to note is that the asset liability mismatch. So especially in the 2008-9 crisis, when money was very cheap, right? So many of these corporates tended to borrow short and lend long, which typically means that they did say 6 months to 1 year borrowings and lend for 3 to 5 years. Now they work on the assumption that when these borrowings come for repayment, they'll get they'll get a rollover of these borrowings at the same rate of interest. But when things go wrong, when liquidity gets tight, the cost of funds become tight, then they are left with, when the borrowings come for rollover, what happens is that either they don't get the money back, or the cost of funds is very high, and that leads to a huge problem for these lenders or the borrower, that is the company that is borrowing from the market. So you have to look at the ALM mismatch and whether these companies are resorting to earning higher carry or margins by borrowing short and lending long, which is a sign of high risk practices by the corporate, right? So this is one of the factors that investors do need to look for while investing in corporate bonds. Yes. So I think these are some main points, apart from looking at the financials and the quality of numbers, etc., that every research analyst will do. And clearly those numbers do tell a lot of things. Rating agencies to put out their rating reports and rating rationals and other things, but many of these do not get reflected. And as we all know, markets are highly what is it called, much ahead of the curve when it comes to corporate bonds or any market price. So they tend to front run, whether it's a default or a company facing problems. They do tend to front run. So some of the market factors need to watch out is that the credit spreads, which is the difference between the corporate bond yield and the risk-free government bond yield. If some of these spreads are very high for an issuer, and say an issuer is rated A minus, and the spreads are at 500 basis points, whereas other A minus issuers, the spreads are at 300 basis points, then antennas need to be up. So this again is a warning sign. So there are a lot of warning signs available. Obviously, investors, especially who do not understand these signs and how to look at the corporate bonds itself in terms of the credit risk, they would need to consult their advisor or go to very strong research houses that provide these kinds of signs. So it's all definitely there is a risk in investments, but there is given that in India the percentage of defaults is extremely low. Yeah. So the risks are not there, but when it happens, a default happens, then there is a lot of angst and that tends to come out, and definitely it hurts every investor. So that's the gist of this podcast, and hope every investor in corporate bonds now will look at some of these factors, or at least ask the right questions to whoever's advising them on investing in this bonds before investing in any corporate bond. Thank you very much for listening in, and do follow us on our podcast channel. Yeah.